Welcome to the Deep Dive. If you're looking to quickly get up to speed on complex topics, you're in the right place.
Yep, we cut through the noise for you.
Today, we're really digging into a whole bunch of recent financial news, stuff that seems to point towards some potentially big shifts, or at least, some interesting uncertainties in the global economy.
We've sifted through quite a bit, articles on market reactions, economic indicators, company statements, the works.
Right?
And our mission, as always, is to pull out the key insights, help you understand what's going on without getting buried in data.
Exactly. So what are we covering? Well, this idea of rethinking U.S. assets, the ongoing impact of tariffs, that's still a big one.
Mm-hmm.
Consumer spending, is it holding up or not? How different assets like, say, Bitcoin and gold are doing. And, of course, AI, it's always there, isn't it?
It really is. Okay, so where should we start? Maybe with that warning from the European Central Bank.
Yeah, that sounded pretty significant.
It did. They actually used the phrase fundamental regime change, possibly underway in financial markets. Wow.
Okay.
And what really caught my eye was their suggestion that investors seem to be reassessing the riskiness of U.S. assets.
And they linked that to tariffs.
Directly. They pointed to global trade tensions, particularly around U.S. tariffs, as, well, a potential trigger for this reassessment.
So the ECB is basically saying these trade policies might be making investors think twice about the safety or maybe the value of U.S. investments.
That's the gist of it, yeah. ECB Vice President Luis de Guindos, he told CNBC that uncertainty is sort of the main theme right now.
Uncertainty, okay.
He highlighted two things to really watch. One, elevated asset valuations, and two, the strong uncertainty around U.S. policy, trade, fiscal, regulatory, the whole package.
Mm-hmm.
And, the ECB has warned about high valuations before, ones not really backed by fundamentals.
Right, I remember that.
What they seem to be suggesting now is that maybe this talk of reciprocal tariffs, hitting back with tariffs.
Tit for tat.
Exactly. That might be the thing that's kind of exposing those underlying vulnerabilities. It might not just be a temporary market dip.
So potentially longer-term consequences?
That's what their language suggests, a potential shift in how global investors see risk, which, could affect the dollar, maybe open up opportunities elsewhere. Emerging markets, other assets. It's a big thought.
Yeah, far-reaching consequences, I think you said earlier.
De Guindos definitely stressed that this U.S. policy uncertainty is becoming a dominant theme. And if you connect the dots, the ECB seems to be hinting at possible, significant changes in where global money flows.
Okay.
If U.S. assets start looking riskier, logically, investors might start looking harder elsewhere, right?
Makes sense. Okay, let's stick with tariffs, but look at the consumer angle, because the picture there seems a bit mixed.
Very mixed, yeah. You've got Amazon CEO Andy Jassy saying pretty clearly that they haven't seen consumers pull back because of tariffs, and they haven't seen big jumps in their average selling prices either. He mentioned they did some strategic forward inventory buys.
Stocking up beforehand to keep prices down.
Seems like it, yeah, trying to buffer the impact.
But that's not everyone's story.
Not at all. Look at Walmart. Just last week, they warned consumers might start seeing price hikes soon directly from tariffs.
Okay, so a warning shot from Walmart.
And Target basically said the same thing. They'll likely have to raise prices on some things.
Right.
But then you have Home Depot saying they expect to hold prices steady.
So all over the map, really. Some absorbing costs, some passing them on.
Pretty much. Jassy did add a little caveat for Amazon while they're trying to hold the line. Some of their third-party sellers have raised prices, others haven't, so it's complicated even within one platform.
Complex.
And if you look at actual trade data, Japan's exports to the U.S. fell for the first time this year.
Oh, interesting.
Yeah, and it was mainly in things like transport equipment cars, basically, which face that 25% tariff. Yeah. And Japan's trade surplus with the U.S. got smaller, too. So, that real-world data suggests tariffs are starting to bite in specific areas.
Okay, so tariffs are definitely a live issue, even if consumers aren't feeling it uniformly just yet. Right, let's shift gears to asset performance. Markets have been jumpy. Bitcoin had a huge run, didn't it? Hit a new high.
It did. Briefly, that surge was pinned on a few things happening around the same time.
Like what?
Well, you had softer U.S. inflation numbers, which was seen as positive. There was a moment where it looked like the U.S.-China trade stuff might be cooling off.
Right, a temporary de-escalation.
Exactly. And then there was that Moody's downgrade of U.S. debt,
Ah, yes.
which kind of fed this narrative for some investors that, hey, maybe Bitcoin is an alternative place to put money, outside traditional government stuff.
The digital safe haven, almost.
That was the idea floating around. And you saw huge amounts of money flowing into those new Bitcoin ETFs, too.
So in that risk-off mood, Bitcoin looked appealing to some.
For a moment, yeah. But what's really interesting is what happened next.
It slipped back.
It did. Right as U.S. Treasury yields spiked up and stocks took a tumble.
Okay, explain that connection. Why would rising Treasury yields hit Bitcoin?
Think about it. If you can get a better, safer return from a U.S. Treasury bond, suddenly riskier assets, and Bitcoin is definitely seen as risky, look less attractive.
Aha, the opportunity cost.
Exactly. Rising yields increase the hurdle. Why take the risk on Bitcoin if safe bonds are paying more? It puts pressure on things like stocks and crypto.
Got it. Okay. What about gold, the traditional safe haven?
Gold's price has been up too. It's seen as benefiting from the same kind of worries, tariffs, U.S. deficits, general uncertainty. People often flock to gold when things feel unstable.
And you mentioned U.S. deficits. Treasury yields have been climbing quite a bit, haven't they?
Oh, absolutely. The 30-year Treasury yield hit its highest level since October 2023.
Wow.
Mostly growing worries about the U.S. budget deficit. The recent Republican spending bill added to those concerns. And of course, that Moody's downgrade, citing fiscal worries, didn't help.
Right, the credit rating downgrade.
All feeding into this upward pressure on yields.
And didn't we see a bond auction go poorly? Like, not enough buyers?
Yeah, the 20-year bond option wasn't great. Demand was weaker than expected.
Which suggests maybe investors are getting a bit nervous about lending the U.S. so much money, or want higher rates for it.
That's definitely one interpretation. It raises questions about, who's going to fund all this debt and at what price. And this all happened alongside a pretty big stock market sell-off.
Yeah, the Dow dropped significantly.
Dow, S&P 500, NASDAQ, all down. Because higher yields make borrowing more expensive for companies, which can hurt profits.
Right.
And it also just makes bonds look like a better deal compared to stocks for investors. So stock prices tend to suffer.
And this isn't just a U.S. thing. Yields rising elsewhere.
We're seeing it globally, too. Japan's 30-year government bond yield hit a record high. So, yeah, these concerns about debt, deficits, interest rates, they seem to be spreading.
Okay, so it's this complex web tariffs cause uncertainty that affects risk appetite. Meanwhile, deficits push yields up, which hits stocks and maybe even crypto. Wow. Okay. But amidst all this, you mentioned AI. Still a big theme.
Absolutely. Despite all the focus on tariffs and deficits right now, many analysts are saying, look, AI is still the fundamental long-term driver for the markets.
Even if the initial, frenzy has cooled a bit.
Maybe the intense hype from last year has come down slightly, yeah?
Yeah.
But companies are still pouring serious money into AI infrastructure. That hasn't stopped.
Right, like Google rolling out its new AI subscription service.
Exactly. Google AI Ultra. Or look at Tesla and their ongoing push for robotaxis, all powered by AI.
So the investment is still happening.
Definitely. And you hear people like Josh Brown over at Ritholtz Wealth Management saying AI is still the main story, the main catalyst, despite these other headwinds. And look at CoreWeave, that AI data center company. Their value soared after they raised, $2 billion in debt. Shows investors are still really keen on funding the AI build-out.
Okay, so AI is still simmering, maybe boiling, underneath the surface disruptions.
Oh.
Got it. Before we wrap up, any other bits of news that sort of fit into this picture?
Yeah, a few things. We already touched on the EU lowering its GDP forecast for 2025 reflects that broader global slowdown concern.
All right.
And the slowing Japanese exports linked to those U.S. tariffs.
Right.
And Target cutting its sales outlook was interesting. They blamed tariff uncertainty, but also mentioned backlash over changes to their DEI efforts.
Oh, so multiple factors hitting them.
Yeah, shows it's not always just pure economics affecting a company. What else? Warren Buffett was out saying stocks still beat real estate long term. No surprise there, maybe.
You would say Buffett.
But on a more worrying note, Klarna, the buy now, pay later company,
Yeah.
their defaults reportedly hit 17%. 17%.
Wow, that's high. It shows consumer strain.
It really points to that, doesn't it? People struggling maybe with inflation and debt. Kind of the human side of these big economic trends.
Definitely. Any others?
Microsoft took down a big malware network, Llama Stealer, just a reminder of ongoing cyber threats.
Always the factor.
There was talk about potential Medicare cuts linked to that Republican tax bill via the PAYGO rules.
Right, the pay-as-you-go rules?
And conversely, how that same bill, if passed, might boost defense companies if Trump's Golden Dome missile defense idea goes ahead. So policy having winners and losers.
Mm-hmm.
And finally, United Health faced some negative reports, allegations about reducing hospital transfers unsafely, and they got a stock downgrade from HSBC. So company-specific issues bubbling up too.
Man, it really is all connected, isn't it?
That's the key takeaway, I think. It is all interconnected. The tariffs affect trade, which affects investor thinking about U.S. assets, which impacts consumer behavior, adds to market volatility. And all that is mixing with these bigger things like government spending, deficits, and of course the huge technological shifts like AI.
So, summing it up for you listening, the global economic picture looks, well, uncertain, definitely in flux. Potential for some really big shifts underway. It's a time to watch closely.
Absolutely. And that leads to, I guess, the final thought for you to chew on. When you look at all these different pieces for trade wars, investor nerves, consumer wallets, technology, government debt, where do you think the biggest changes will actually happen in the global economy over the next few months?
Yeah, what parts are most likely to transform?
And what specific signs or indicators will you be watching to tell you those changes are really happening?
Good questions. Something to keep thinking about as these stories continue to develop. We encourage you to keep exploring these connections.